we hear a lot about contractors self-financing or bringing finance. What does that mean? Does that mean working with the banks to borrow more, or does it mean export credit support?
It's mean both. You can either borrow locally from the banks and put an offer with the banks locally, or bring export credit and bring it to the region and try to develop the project accordingly. It's still touch and go. There is a couple of projects which have been done with Expo Finance successfully in the region, not by us, but by colleagues and competitors, contractors. There is others where the client have gone, and then when they calculated the cost of the finance, they found out they can borrow money less expensive than the contractor can do, and they went back to the traditional.
So that brings in the banks again, of course. So if contractors are being asked to take on the financing, what's the bank view on that? I mean, presumably, as you have just said, the client can borrow at a lower rate normally.
Correct.
So is that a good model?
For the contractor to bring in the financing, we need to understand who is going to be the borrower on record. A lot of the paymasters expect that the contractor becomes the borrower on record and brings in the money, takes that risk with the banks, and then fund the project. What we have been talking about with a lot of our customers who came about with the idea is that we would be happy to look at providing a finance to a project, provided that the structure of the project, the assets that belong to that project are all rank fenced, all the rights are available to it. You have recourse outside the contractor. Other than that, if you only keep it on the contractor, of course the price will be higher, the cost will be higher, because the banks will start add on or price that risk in a completely different level. Hence, when they looked at the cost, they found out that it's easier to borrow directly rather than go through the contractor.
The only reason is that for asking the contractor to borrow is because it creates capital immediately rather than the overall costs.
I would disagree with that. Because if I may, and I think that's the problem, is that you typically, a client who's not educated in the concept, doesn't have experience of what a private sector finance project will be or a contractor finance project will be, will think, oh, it's a way to get it cheaper, I don't have to put the money up front, and that's the reason to do it. That's not the reason to do it, because as rightly been pointed out by Mohammed, the contractor is not necessarily going to get cheaper financing than the client, because at the end of the day, it's the credit rating of the client is going to drive the cost of the financing of that particular project. So what you need to, the decision is based on allocation of risk and certainty, because when you have somebody effectively with experience managing that project, looking at the overall 25 years or however long the life cycle of that project is, they can optimize, they can guarantee the delivery. The chance of a variation order, for example, is much less, because you set everything up front, you clarify it, that's it. This is what we are delivering at the end of the day. Versus, so it's not that it's cheaper, it's that it's more certainty. It is probably, it is likely to be cheaper in the long run, because you won't have the variation orders, and you'll optimize your operating cost up front. But if the issue is, if somebody says, give me an EPC offer, give me a BOT offer for the same thing, and then they take the EPC offer and they go to their bank and they say, how much will you lend me money at? That typically is going to be cheaper. The problem is further down the line, that's going to be more expensive if it's not managed properly.